Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Tom Dunkell. Tom has a background in corporate finance and over 25 years of real estate and investment experience. Tom brings extensive experience to Belrose Storage Group, taking the company from a startup to a world-class organization. And in just a minute, we're going to speak with Tom about self-storage syndications. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest. Tom, welcome to CRE PN Radio.
Thank you, Darren. It's great to be here. And I do hope the listeners go to YouTube because I wore my favorite shirt today in honor of our conversation. So.
Well, that's awesome. I appreciate you doing that. And
Sure.
I hope they do too. Hey, Tom, before we get started here, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I'm one of those annoying MBA guys. I got my MBA in finance and accounting and went into corporate America, did corporate mergers and acquisitions and raising capital in the aerospace and some other industries. So it was great training. I worked with some amazing people. I really did. And even though it was, getting to be a long time ago now, I still reach back to that time for lessons learned and from leadership and, just how to grow a business the right way and those kinds of things. So I ran that out for a while but always wanted to go and do something on my own. And so in 2006, my timing wasn't great, but I left corporate America. Actually kind of abruptly because I got fired from my corporate job. But it was just the kick in the pants that I needed to go out and do what I had been wanting to do. And I feel like what I am meant to do. 2006, obviously my timing was horrible. So learned a lot of tough lessons those first few years in real estate. So I definitely still have the battle scars and the lessons learned from that tough time. But just had to keep, battling through and grinding. And so I reinvented after spending some time in residential real estate, started when I had rentals and I was doing fix and flips and wholesaling and those kinds of things. I went into distressed mortgage debt, which ended up being a great business, just kind of the right place at the right time. I connected with my business partner, Joe Downs, in 2010, and we started U.S. Mortgage Resolution, which is still thriving today. Over the past 12 years, we've generated over $50 million of revenue in that business, acquiring over $800 million of distressed mortgages. That's the unpaid principal balance. So we had a great run with that business, which allowed us to do some other things, including hard money lending. We have a real estate. We have a rental portfolio, a short-term rental portfolio in a vacation spot here in Pennsylvania called the Pocono Mountains with lakes and such up there. But our big push right now, and really what we're most passionate about at Belrose, is storage. So we've gotten into storage. We started buying facilities back in 2020, leading into 2021. And now we're about to acquire our 10th facility. We've got about 250,000 square feet of storage. And we just are big fans of this asset class.
Awesome. So you mentioned kind of your start, and you would did you do single family to start with? I mean, I heard that you got into the hard money, or not the hard money, but the mortgages and that. But your initial start, were you doing single family, or did you jump into a different asset class, or what?
It was mostly single family, a few small multifamilies, duplexes, triplexes, quads, that kind of thing. But interestingly, I did start investing as a passive investor in multifamily in 2013. So that's been a great run as well, and a big fan of that industry. But just as a passive investor there.
Got it. And how did you guys arrive at self storage? What was the attraction?
Yeah, great question. It's there's quite a laundry list of things that we really like about it, but the highlights are, I mean, first of all, it's real estate, right? So it's a hard asset. It's not going to zero. And like the old adage says, don't wait to buy real estate, buy real estate and wait. So we love that about it, and it comes with all the tax benefits of being in real estate as well. Second big thing is cash flow. Our operating expenses at a facility are very modest, typically around 30% of our revenue, give or take. So that gives us a lot of cushion to generate cash flow. And, in the uncertain times that we're in right now, that gives us cushion. If the economy were to take a dip, we can adjust our rates and still be okay and cover our debt and that sort of thing. So we love the cash flow aspects. One of the other big things we like about it is the capital expenditures are usually very low. When I do invest in multifamily, I know there's a lot of times that a big capital expenditure budget set aside to account for turnover in units, because they need to go in and upgrade the lighting package or the countertops or the appliances and paint, carpet, what have you. In self-storage, when a customer moves out, we can roll up that door and just sweep it out and put it back up. For rent, that's pretty much that same day, and that does happen. So we do like to have our facilities looking nice. So we do spend a little money on landscaping and of course keeping the trash picked up and all those kinds of things, but those are relatively low dollar. We do for sure spend money on security, because we want our facilities to be secure when our customers feeling comfortable doing business there. So we'll put up video cameras and make sure that the gate is up to par and that's all working and all the fences are taken care of. But those are the big primary things we like about real estate or about self-storage. If I could maybe throw in one more thing, is that it's becoming more and more mainstream self-storage. It used to be that self-storage facilities were these rusty, dusty old boxes stuck in the back of an industrial area. But now it's becoming more mainstream. You're seeing like old Sears buildings, old Kmart buildings being converted into storage. You're seeing new storage facilities being built in more retail convenient areas. And that's all because self-storage is becoming more and more utilized and more mainstream.
No, I get all of that. That's good stuff. Did I hear you right? Did you say that your expenses for on your cash flow for the self-storage runs about 30%?
Yeah, it's about right. On smaller facilities, it might be more like 35, but on larger facilities, it can even be less than that.
And does that include the are you guys actually managing these directly? I mean, do you have like the staff and that, or do you
We do. That's a great question, Darren. So one of the ways that we do keep our expenses down is we are shifting to more of a remote managed model. In some cases, it's kind of a hybrid situation where we do have boots on the ground in that market, but they're not spending all day every day at the facility. They might be an hour or two drive away, and so they'll go by the facility maybe once a week, but they're still managing the facility from afar because they're fielding the calls from the customers. And of course, today most customers are wanting to just do business on their smartphone, so they can rent a unit on their smartphone and then just move in at their convenience. So we're finding, at least the way that our management strategy works, is that we don't need an expensive body on site all the time. So we're able to really keep that piece of the expenses down, which is, as everyone knows, headcount in any business is probably your biggest expense.
Got it. With that, are you guys able to do upsells or whatever? I know, like I've talked with others about this, and whether it be the U-Haul vans or the boxes or the whatever additional things. Do you have any kind of a storefront that allows for that, or is it more of just the space rental?
Yeah, our model, Darren, as far as upselling, we haven't gotten into the U-Hauls and the boxes and those kinds of things. Because that does take more attention and personal attention, meaning another body kind of thing. And the boxes and those kinds of things, there's not a ton of margin there. But one thing we do apply as one of our value add strategies is protection plans. So we require our customers to purchase a protection plan from us, and it allows us to make a few extra bucks per month per unit. But as everyone knows, and if you're familiar with commercial real estate, every dollar of revenue that you can increase the net operating income, you get that multiplier effect on the value of the business. So so a medium-sized or smaller facility where you're offering tenant protection on top of your regular rent, it might increase the value of that facility on your NOI because you're getting that NOI multiple by $250,000 without a lot of headaches. So it's pretty nice.
No, that's awesome. So your self-storage asset class, is there a particular territory, or are you guys nationwide? How are you selecting where you locate these?
Yeah, so we're trying to ride the demographic trends, of course. We've got the baby boomers are selling their big houses up in the Northeast, and they're moving to the Southeast and just having to store their stuff. So we're focused on the Eastern U.S. Our facilities today are in Maryland, Virginia, North Carolina, Georgia, and Florida. We're currently looking at a deal in New York State, which isn't like a super thriving, growing market. However, this, real estate's all very local, right? So this particular area has a big Costco retail center that's going in, that's going to draw a lot of traffic to that area. And the facility we're looking at is right across the street. So we're excited about that one. And we've looked at deals in Alabama, Ohio, but we're very selective. We want to make sure that there's a lot of value to add there. That's our primary strategy, is acquiring existing facilities and just running them better.
Got it. And as far as the kind of the investment strategy, do you have a particular hold time that you're looking to hold these, or is this a forever hold, or what's your plan?
Yeah, good question. So first and foremost, when we go into a facility, like I was saying, we want to have a lot of value add strategies, and those are all meant to really increase the cash flow of the facility. And what that gives us the ability to do, the luxury to do, is be selective about our exit strategy. So if the facility is running the way that we want it to be running, we can hold it until we see there's an optimal time to sell, or maybe it's part of our portfolio and we sell the whole portfolio at once. But in general, we're not super long-term hold guys. We're typically in the I would say the 2 to 5 year range. again, because we are acquiring existing facilities that are poorly run. So once we turn those facilities around, that's our opportunity to capture the best return for our investors. And so we'll typically look to be exiting at that time.
Got it. So let's talk a little bit about your syndication model. Are you guys are the GP that are finding the deals and then raising the money, LPs? Is that pretty much the strategy there, or is there?
No, in a nutshell, Darren, that's exactly right. So my partners and I act as the GPs, and we bring in the passive investors to be our limited partners and our passive partners. And so we spend a lot of time and effort finding the deal. We probably look at hundreds of deals for every one that we buy. And then we're doing all the upfront due diligence. We're arranging for the debt financing, which me and my partners sign for personally. At least at this stage of the game, we've been using recourse debt through credit unions and small local banks. That's where we've been getting the best execution. And then once the deal is closed, we're handling all the back office operations, all the investor reporting. Everything lives in our investor portal, so our investors can have full transparency with what's going on. We post all the management reports there, and move-ins and move-outs and rent rolls and occupancy reports, and all those things live in our investor portal. And that's where all of our investors get their K1s, and their distributions are made out of our portal as well. So we're really happy with that. It's a pretty slick feature that we just added in the past year or so. So we're really liking that. But yeah, that in general, that's the model.
Got it. So one property, one raise, one syndication. Is that as opposed to a fund where you basically have multiple properties under the same fund? Is that? Do I understand that right?
That's exactly where we are. We're a deal by deal shop. We seem to like it that way. We've kicked around the idea of maybe doing a fund. However, I know as an investor, I'm more comfortable if I'm investing in a deal where I know exactly where the money's going, and I can look at that specific property and make my own decision. So that I like that personally. So it seems to be that's the way that we're heading with Belrose Storage Group, is doing one deal at a time.
No, I like the model. I just curious. I know I've talked with some people, and it seems like some have graduated, and I say graduated. They if some, I guess it's the issue of if you're raising capital and you have deals, or you don't have deals, and you're trying to match that up, kind of thing, as opposed to this is the opportunity to get in, before it's gone, kind of a thing, is more of what I think the syndication model is. And if you're producing results, I would think that it doesn't really matter. And if you have investors and you're producing results, I'm guessing, what's the problem here? No problems.
Yeah. I think if you get to a certain scale, fund might make a lot more sense, but we've never wanted to be a big company, Darren. We think of ourselves, in fact, one of our core values is here at Belrose Storage Group is SEAL team. And so we just want to be an elite premier fighting force that's, smaller, but we go out and we execute with passion and excellence. And so we're not looking to be the biggest, but we certainly to this point have executed really well. Our investors are quite happy, and they keep bringing in their friends and family to our deals, which is a great testimony for what we're able to deliver for them. So we're really proud of that.
Got it. And you mentioned the lenders you guys are currently using, that the partners there are actually signing on the loan. What is the lender appetite for self-storage? Is it pretty robust, or is it kind of lender by lender?
We've had lenders come to us before saying, "Hey, I've got a mandate to fill up, our portfolio with self-storage. So, send everything you got to us." So now those seem to be the, kind of the more smaller regional lenders. Like actually, a good friend of mine is a commercial banker at Bank of America. But it's just too, I guess, too small for him. He's used to doing these massive loans. And so I was giving him a hard time about it one night. And he actually called his boss and was like, "Hey, how come we're not lending in self-storage?" But I guess it was just a scale thing. Like typically self-storage deals. There are some big ones out there, but a lot of times they're more on the smaller end of the scale. If you're a Bank of America looking to fill up your loan portfolio with 100, 200, $500 million loans, it's just not going to happen in a self-storage deal typically.
Right. That's pretty big self-storage. And I guess unless you had like a portfolio kind of thing, but even that, I don't know, that would make as much sense.
Sure.
But so in your deals, what is an average deal size for you mentioned what I think you said 10. You're focusing on your 10th, and you said 225,000 square feet. Is that total, or is that the one deal that you're focusing on right now?
Yeah, so we're at about 250,000 square feet across our portfolio right now.
Okay.
Our average deal size is about 2.5 million. So these are smaller, kind of mom and pop run facilities, but that's where we've been finding the best turnaround and value add opportunities. So that's what's driven us there, and we're not running into any of the huge private equity firms that are throwing around huge money and super low cap rates. So we're happy to just stay in our lane and stick to those types of properties. And just if I could go back for a second, make another point about what's happening with the lenders, Darren, is self-storage has quietly been the best performing asset class in commercial real estate for many years, and the default rate is super low. So lenders typically loving to lend on self-storage properties.
No, I would think that if the bank wants to lend you money and and they recognize it's a good thing, and I mean your number, your 30% expense rate, I'm just going like, wow, that's pretty impressive. And just the easy turn. I mean, is there any kind of eviction? I mean, are you beholden to any of the eviction laws that like multifamily has, or things like that? Or
No, not at all. Not at all. And that's, I mean, if at the beginning, if I could have, kind of gone on with my laundry list of things that we love about self-storage, that would have popped up pretty soon. But we live in the lien law world, not in habitational real estate where it's a landlord-tenant situation. And there's a lot of landlords out there know, like I used to be a landlord, to evict a tenant, you got to go to landlord-tenant court. And in a lot of places, that court is very much slanted in the favor of the tenant. And I lived through that personally, and it was no bueno for me. But in self-storage, there was no eviction moratorium during COVID, and the lien laws are very clear. You are able to give notice, and then a short time later, depends on the state, could be 30 days, could be 60 days. You can put that facility's contents up, that unit's contents up for auction, sell it online. That buyer comes over and they have to clean it out. And then we have a unit available for rent again. It's not a big to do like it is in habitational real estate.
So when you do have one of those, I don't know, I'm thinking of that, what's the reality show, the Storage Wars there, or whatever, where you sell the contents. Who owns the contents at that point? Is it still the tenants, and then they get the proceeds, or are you now the owner of the contents?
So what happens is, and this actually never happens, but what happens is the proceeds first go to pay the back the delinquent payments, and then if there's anything left over, it would go to the customer. but that the unit's contents go for very, very little money, and it usually doesn't cover what's owed to the facility. So there's never any money left over for the customer.
And
in my experience.
Yeah. No, and in those situations, is it kind of a blind auction, or do people kind of look at it and say, I'll get, I mean, are they go through it, or?
Yeah, it's honestly, it's pretty crazy if you ask me, because again, everything's done online now. So our managers will go in there and they'll take a handful of representative pictures, but they're certainly not pulling out all of the contents. So the buyer of the contents of that unit is really going on very little information. They might be able to zoom in on the picture and see something valuable, a piece of equipment or a tool or something that maybe they'll extrapolate from there, like, hey, there's tools in here, I'm going to invest, I'm going to bid more. But it's pretty risky, because if you roll up the door and it's full of stuff, you don't know what's tucked way in the back.
Yeah.
So I don't know.
Definitely a bargain hunter's. I don't know. Yeah, that doesn't really interest me, but
me neither.
Yeah, no, I like the tenants that pay their or the storage. The people that pay their rent and they keep their stuff. That's the best one. What is the just kind of curious, talking about the how you recoup on somebody that doesn't pay. What is the default rate of tenants? Is there a national number for tenants that don't pay their storage bills?
Yeah, there are national statistics on that, and again, at Belrose Storage Group, one of the things we really focus on, because it is in our control. Can't really control interest rates, cap rates, all that stuff going on out there. But what we can control is how we run our facility. The national average for delinquencies is 10%. Across our portfolio, we're about 3.5%. And so what that does is that further increases the cash flow that we have available for our investors. So we're very, very proud of that figure.
That's awesome. I mean, such a low delinquency percentage. And if you do have somebody that goes delinquent, I mean, I'm assuming is it 30 days? Is that kind of the what's the point when they're delinquent and they
31 days they get a notice.
All right. And so at that point, do they lose access to their? I mean, with digital, you don't have to go in and rekey the thing. You undo their code or whatever kind of thing, or so they can't access their stuff until they make payment. Is that basically the?
That's right. Yeah, their gate code won't work at the gate, and then there'll also be an overlock on the actual unit. So they'll have their lock on there, and then we'll put a lock on top of that, and then they need to talk to us and get caught up before they can access their unit.
I love that model, just the ease of compliance there, as opposed to being strung out for months, or with COVID years, or whatever it could be for particular
right.
trying to get back kind of thing. So that's awesome. So the future here, what's your guys' plan? You mentioned you're not looking to compete against the big funds and stuff, but kind of the small, is it basically continue to find deals on the East Coast there and try and grow your portfolio, or is that what's the long term?
Yeah, absolutely. No, that's hit the nail on the head. We've found a lane that we're really good at, and that's where we're going to stick. We're very selective about the facilities that we buy. We're not out there trying to gobble up every single facility that's for sale. As everyone out there knows, it's easy to buy real estate, right? If you pay cash, pay the asking price, and close tomorrow, you can buy as much of whatever real estate class you want. But for us, that's not our approach. We're very diligent. We're very disciplined about the kinds of facilities that we acquire, and it's all because we want to do the best job we can do for our investors. We want to reduce their risk, increase their cash flow, increase their returns.
No, that's great. Your team, who all is on your team for your
Sure.
partners there?
Yeah, so the core team is myself, my business partner, Joe Downs. For our self-storage venture, we've brought in Tim Kane. He's an expert at lead generation and also is really good in the expansion and construction aspects of our properties. We don't do big developments or anything, but we will do small expansions if it's warranted. So that's where Tim comes in. He's an extremely valuable resource there. And then we have the glue. Every good company, you got to have the glue. So our glue is Gretchen Frischella. She's our chief of staff. She makes sure that everything's running smoothly, everyone's communicating well, everyone's sticking to our core values. So she's been a great resource. And then we have a great accounting team, because with every facility, we have new entities that are formed, new bank accounts that are open. So that accounting aspect gets pretty heavy pretty quickly. So we've got a great team there. And then further on the operations side, we have an outsourced expert consultant that we work with there, named Catherine East. She's with Elite Self-Storage Advisors, and she's been in the self-storage industry for 16 years now and has managed and done turnaround and auditing work on self-storage facilities around the country. So she's a tremendously valuable resource as well. And what she does for us is she helps to transition the property from the prior owner, moving everything over to our systems and processes and methodologies. And then, as I mentioned, she does the auditing and gets the marketing up and running and rolling. And then she also brings in someone from her team to manage the facility as well, or she'll hire someone if there's no manager convenient to that location. So she's an outstanding resource as well. And that's pretty much the core team.
Cool. You mentioned marketing a little bit there. Do you guys, is the marketing outbound to prospective sellers, or is this also marketing for investors to raise capital?
Yeah, great question. It's really all the above. So we have the lead generation and marketing engine that we turn on for reaching out to facility owners. So we have a VA that helps out there. We're reaching out to hundreds of facilities a week. So there's a whole process there. And that's Joe Downs, my partner. He's pretty much running that aspect. On what we call the capital servicing side of things, that's when it comes over to my area of responsibility. So we do have a marketing program there as well. We're reaching out to investors and making sure we're trying to add value all the time. So anyone who signs up in our investor portal, I'll be sending out articles that I think are interesting about what's happening with inflation, what's happening with cap rates, what's happening with interest rates. How are rents, trending in self-storage and even other markets, other commercial real estate markets, just to try to be a thought leader and have a finger on the pulse kind of thing. And then at the facility level, there's marketing going on there as well, because we're reaching out. We want to be, in the top 3 on the Google search for that market, and we want to make sure that everything's smooth for the customer to rent that facility on their smartphone. And so we've got a lot of different ways that we're reaching out to our different constituencies.
No, it's important. I mean, you got to, I've always been kind of reluctant to do the horn tooting, but if you don't toot your own horn, likely nobody's going to know you have a horn. So
that's right. That's right. Well, and the good thing for us, I think, in my particular area of responsibility, the capital servicing, like I mentioned earlier, our investors tend to refer people to us, which of course is the best way to get business, right? I'm sure that's the same way in your business and insurance. You get that referral from someone who's already done business with you, so that has huge weight, right? So,
right.
So that's why we really try to go the extra mile to make sure our investors are having a good experience with us.
No, that's great. Hey, Tom, if we could, I'd like to shift gears here for a second. As you just referenced, by day, I'm an insurance broker, and I try and work with my clients to assess risk and determine what to do with the risk. And there's a couple different strategies we typically consider. We first look to see if there's a way we can avoid the risk. And when that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be clients, investors, tenants, market, politics, you name it, however you would like to define the biggest risk. And for clarification, I'm not necessarily looking for an insurance related answer. So if you're willing, I'd like to ask you, Tom Dunkell, what is the biggest risk?
Well, like lots of business owners out there, Darren, we have a number of different risks that we're faced with on a daily, weekly, annual basis. In the like in storage, as I mentioned earlier, we're avoiding development projects because we just see a lot of risk in those right now with supply chain issues, labor issues, material cost issues, and it's just not really in the DNA of our company. So we're avoiding that one entirely. On the facilities that we do buy, we minimize risk by not over leveraging, by being conservative with our projections. And of course, we use insurance to make sure that the physical plant is properly insured. But as far as our biggest risk to our business, Darren, I would say it's really me. It's really me and our leadership team. The business can only grow and go so far as we're able to take it. So we have to be the best that we can be. We have to be educated and smart and hire the right people and bring in the right partners, because if any of those things get out of whack, we're not going to reach our potential. And that's what we're here to do, reach our potential and provide value to our investors. So we're always looking for ways to improve ourselves and improve our business. As I mentioned earlier, we do have core values, we do have a purpose, and so we use those as our guideposts every day in our decision making. But we're always looking for better ways to do business, to take care of our investors, and just be good members of our business community.
No, I like it. That's good stuff. Hey, Tom, where can the listeners go if they'd like to learn more or connect with you?
Yes, so again, I'm Tom Dunkell, Managing Director and Chief Investment Officer at Belrose Storage Group. You can go to belrosestoragegroup.com. It's BELROSE group.com and belrosestoragegroup.com. And I would encourage folks to go there, whether you're interested in participating in our self-storage and syndication deals or not. We do have a free resource there for investors. It's something that I've developed over my years of investing. Actually started investing as a kid, but I've been a high net worth investor since 2006, accredited investor since 2006. So I've made some mistakes along the way. I've learned some lessons. I've done some good things. I've done some not so good things, but we compiled them in an ebook that we call Safe Investing. And SAFE is an acronym, SAFE. S is for sponsor, gives you a list of questions to ask about who's sponsoring the deal. What's their background? What's their track record? Are they criminals? Have they done this before? How long? And then A is for asset. What is the asset you're investing in? It's incredible to me. Sometimes people invest in things and they don't really understand the asset they're investing in. So it gives a list of questions to ask about that particular asset to make sure you understand it. F is for financials, gives you a list of questions to ask about the projections, the returns, and also personally, like how much of your portfolio are you putting at risk here, and are you okay with that? And then E finally is for exit. How do I get out of this thing? You can't go to schwab.com and click, sell your position in a Belrose Storage Group storage deal, because that money is going to be tied up for 2, 3, 4, 5 years, and you need to know that going in and be comfortable with that as an investor. And ultimately, Darren, all these questions are really designed to help an investor feel good about what they're investing in and be able to sleep at night knowing that they have their money tied up with this sponsor and that asset with these financial characteristics and when they're going to get out of this. So I think it's a valuable resource. I hope everyone goes to get it. It's free. You don't have to give your name, email address, or anything. It's just available for download on our website.
Awesome. Well, Tom, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you, Darren. It's been great. Appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.